can you avoid taxes on inherited IRA RMDs? Imagine inheriting an IRA and wondering if there's a way to keep more of that money without giving a big chunk to taxes. Well, let's talk about what really happens with inherited IRA required minimum distributions. When you inherit a traditional IRA, the law says you must take RMDs each year. These distributions are considered taxable income, so you usually owe taxes at your regular income tax rate. That means, in most cases, you cannot avoid paying taxes on these RMDs. However, there are some details that can help you manage the tax impact. If you are a spouse, you have more options. You can treat the inherited IRA as your own, which allows you to delay RMDs until you reach the age of 73 or 75, depending on your birth year. You can also roll over the inherited IRA into your own account, which keeps the money growing tax-deferred and postpones RMDs. Or you can keep it as an inherited IRA and take RMDs based on the deceased spouse's age or life expectancy. For non-spouse beneficiaries, the rules are different. The law now requires most non-spouse beneficiaries to fully withdraw the inherited IRA within 10 years of the original owner's death. This is called the 10-year rule. You can take distributions at any time during those 10 years, but the entire account must be emptied by the end of that period. If you don't take the RMDs or leave the account open, you face a penalty of 25% of the amount you should have withdrawn. If you correct it within 2 years, the penalty drops to 10%. When it comes to taxes, the distributions from traditional inherited IRAs are taxed as ordinary income in the year you withdraw them. You cannot avoid this tax, but you can plan your withdrawals to spread out the tax burden. For example, taking smaller distributions over the 10-year period can help prevent a big tax hit in 1 year. Roth IRAs are different. If you inherit a Roth IRA, the distributions are generally tax-free because taxes were paid on the money when it was contributed. Still, the account must be fully distributed within 10 years. This means no taxes on the distributions, but the account balance must be emptied within that time frame. One common misconception is that you can convert an inherited IRA into a Roth IRA to avoid taxes. Unfortunately, non-spouse beneficiaries are not allowed to do this. Only spouses can convert inherited IRAs into Roth IRAs. So, to answer the question directly, you cannot completely avoid taxes on RMDs from a traditional inherited IRA. But, by understanding your options and planning your withdrawals carefully, you can control when and how much tax you pay. Spouses can delay RMDs by rolling over the account or treating it as their own, which can help with tax planning. Roth inherited IRAs do not generate taxable RMDs, but you still need to fully distribute the account within 10 years. In the end, working with a tax professional can help you develop a strategy that minimizes your tax impact while complying with the rules. Proper planning can make a big difference in how much of your inheritance you get to keep.